Thank you, Tay. Thank you. Good morning, and welcome to Hong Kong to our second FIC conference. Last year I spoke here as well, and my colleague reminds me that last year I overran by about 30% of the time allocated to me, so they're going to wave to me if I overspeak today again. So thank you very much. This is the second time, and we have a much larger audience, 650 people registered for this conference. And we have a lot going here, so hopefully throughout the day you will be able to communicate and discuss, and together, collectively, we're able to figure out where we go from here. And the big discussion today is obviously today, this conference, the second conference, is after the Stock Connect was launched back in November, and our market has now transformed significantly, particularly after April. So the question people keep asking is whether or not the Connect model that we have built with Shanghai and to be with Shenzhen in the coming weeks and months, and whether that model can be replicated in the fixed income space and currency FIC space. But the real question we really need to ask ourselves, and we need to continue to work through your own professional work in the area. But as the exchange, as the market organizer and operator, we all need to really, figure out three key questions. Why China needs RMB internationalization, why China needs FIC, RMB FIC strategy, number one. And number two, why foreign investors, international investors need to really pay attention and need to, really consider making investment there, and how Hong Kong can help. That's really the three questions. Why China needs it, why do we need it, and how Hong Kong can help. And on the why China needs it, clearly China today is already the third largest bond market, in the world today. And however, the mainland, overall the mainland bond market, even despite its massive size, is still very much of an insulated market. It is still a very concentrated market, and whether most of the credit are still overwhelmingly concentrated in the domestic market. So a global deployment and diversification is something that China desperately needs, and this trend is going to become more intensified over the coming years. So therefore, they really needed to begin to think about their market in global terms. Their fundamental underlying economy is already globally connected, but the financial system, particularly the fixed income system, fixed income market is still largely closed. And mainland banks significantly needs diversification, because the biggest challenges of almost all the mainland banks, in addition to all the credit issues and rates issues, is really a massive mismatch of maturity and a liability. And the rates environment is still very much controlled, even though it's really seeing rapid acceleration of the liberalization of the rates market. So maturity mismatch, and they really need to seriously, over time, lower the overall funding cost. So diversifying beyond China and importing funding sources from the global market is becoming more and more important for China. So today, the market in China is still, we all know, still heavily regulated. The pricing and allocation, pricing of credit, allocation of resources, allocation of credit are highly inefficient. And despite the fact that this is probably, is the safest banking system in terms of stability of its liability side, meaning the investor, the depositor, you can't really ask for a more secure depositor base in any banking market today. We have over $20 trillion US dollars of China's depositors' money still in the banks. It's largely a depository culture, and people are still saving. They save a lot more than they consume, and the balance sheet on the liability side of the banks are extraordinarily stable, because almost everybody still assume some level of sovereign guarantee. So as a result, despite the credit quality challenges that we have seen, in many, many sectors, China's bank on the balance sheet, on the liability side, is still very safe. But that safety, however, is really becoming a source of problem because the banking sector is safe, but is extraordinarily inefficient, and there's no real competition. There's no real market setting of interest rate. The cost of the credit is not being properly priced, and small and medium enterprises still have significant difficulties and challenges accessing credit. So all of that clearly indicating a strong need, and China's policies have clearly manifested itself as in tremendous transformation over the last few years, and accelerating as we've seen today, in changing and rapidly moving that. Even China's big national strategy of One Belt, One Road, the AIIB, and all the major initiatives that China is going to undertake to essentially put China on the global map. All of that requires China to find a better way to price that credit. We all know there's going to be a lot of export of excessive capacity from China to outside China, and there's going to be a lot of allocation of credit out of China. But that credit need to be properly priced. That credit need to be properly diversified, and China needs to make sure that while those major advancements in China's overall national interest and economic power need to be coupled with its ability to source funding from more diversified sources. It needs to be coupled with China's ability to be able to price that differently from the way they are currently pricing it in China. And it needs to be matched in maturity. You cannot have all these major infrastructure projects out of China in very long durations of maturity while you're trying to fund that with essentially short-term deposit in the banking system. So there got to be a significant amount of effort that they have to make to essentially, even though China today, a lot of the China sovereigns no longer come out to issue funding anymore. Many of the Chinese issuers are not coming to international market to issue as much bond as we think they should. And because China today, for the last 20, 30 years, China is being essentially, savings. As a sovereign state, is really, collecting assets, issuing capital, and trying to taking capital into China is a lot more, is the most important thing China, has been really focusing on for the last 20-some years. Today, China is already becoming a real big capital, excessive country. It's from a capital importer, China is transforming itself into a capital exporter. But in exporting that credit, we really want to make sure that we believe with high level of conviction that China will have to move into a much more internationalized market in terms of rates, in terms of credit, in terms of currency exchange rate, and in terms of sources of funding, so that allows China to truly able to advance its economic power beyond its borders into the international market, but under internationally more competitive pricing and allocation processes. So we all know, so therefore we are very convinced that China needs to take that step, is accelerating that step, and all the policy initiatives that we are witnessing clearly are going into that particular direction. The second question is really, if China is moving fast, do the international investors need to really begin to shift into this particular area? And the answer is a resounding yes. China is already the second largest economy in the world today, and China's market, whether it's bond market, whether it's equity market, is already becoming either the second or the third largest in the world today. So global investors, global banks, global financial institutions can no longer accept the small little exposure that we all have into that massive economy. So today, foreign international investors only accounts for less than 2% of the overall outstanding bond market of China. That clearly does not reflect the right weighting that need to be ascribed to China. We have all read reports over the last couple of days about the inclusion of China's domestic equity market into the MSCI Emerging Market Index. We are all also reading with great interest the development of the IMF's continued consideration of including RMB into the SDR basket. And we probably, whether or not we're going to see any action this year, we all know that something action could happen for MSCI. We didn't see anything definitive, but there's a clear statement of intentions and clear statement of landmarks and clear statement of visibility and roadmaps as to what need to happen before that inclusion happen. This is the first time that sort of a clarity and visibility have been established. And I think we're going to see potentially similar development in the SDR discussion at the IMF. Whether or not in this October that will happen or not is anybody's guess. But we all know that even if it's not going to be this year, it's going to be happening soon. So it's not a matter of whether those inclusions, whether in equity, in fixed income, in currency, actually happens. It's not when it's going to it's not about whether it's going to happen. It's not even about when it's going to happen. It's really about how fast it's going to happen, how large the initial inclusion is going to be, and how rapid they're going to accelerate the additional incremental inclusions over time until they reach full inclusion. So we're really talking about the pace of what's going to happen and then the extent of what's going to happen. So many of this development putting pressure on international investors to really begin to understand this market. As difficult as it is to understand it because it's still largely insulated, it is time and it's really everybody's prerogative to understand it better because that's where the profitability is going to be, that's where the diversification is going to be, that's where the future is going to be. So then what can Hong Kong do and help in that particular regard? I think in the past, Hong Kong is not known for being anything other than a cash equity center. And the last 20-some years, the Hong Kong Exchange, for example, our own business model is a very simple one. We essentially did business only for two people. One guy is China's users of capital, Chinese issuers of capital, Chinese listed companies. The second guy is international investors. 20 years ago, Hong Kong is a regional market with regional listing and regional investors with some small international participation. Overall market cap is about 3 trillion Hong Kong dollars 20-some years ago. The first business we did 20 years ago is to bring the Chinese issuers of capital to Hong Kong. That in turn attracted international investors to Hong Kong. Our business model of the last 20 years is basically that. We brought two guys into Hong Kong, and then one guy took the money into China and leave a piece of paper called equity, and we have been trading that equity for 20 years. That's our business model. So we were not known for anything beyond equity and then some equity derivative markets. That is changing rapidly now. We are now looking at commodities. We bought London Metal Exchange. We want to make sure that Hong Kong become a center over time of commodity and commodity futures. And we have a unique strength in doing that. We don't have a physical strength to do that because we do not have a lot of land mass for us to build a lot of logistic and warehouse systems for all bulk commodities. But for commodity trading and futures, we have the best combination of one country, two system, where we have the biggest economy, the biggest financial, potentially the second biggest financial market in the world today right next to us, but we also have an international legal and regulatory and a market system that is completely transparent and acceptable and accepted and admired globally, by all international investors. So that unique combination gives us the unique edge to push into commodities and push into FIC in the next stage. FIC is even harder. I think if we look at the Connect model, the Connect model, going back to my the last 20 years of business model, is two guys brought to Hong Kong, and we the Shanghai Hong Kong Connect, the mutual market access program that we have been pushing, we continue to push, essentially brought the third guy to Hong Kong, that is Chinese money, Chinese investors. Now Chinese investors here, and we have a massive amount of money that potentially will be able to be opened, and the bulk of it could be opened through Hong Kong, and that obviously provides us with tremendous opportunity to bring the fourth guy into Hong Kong. That's international users of capital, international issuers of capital, international users, international risk managers who need to use our market, use the liquidity to manage their risk, whether that's credit risk, whether that's interest risk, whether that's exchange rate risk. And on top of all of that, when you bring different investors, Chinese liquidity into Hong Kong, not only it will attract international users, but we will also attract tremendous more incremental international investors to Hong Kong because liquidity want to meet liquidity, and they together, particularly liquidity of different characteristics, have tremendous potential of creating chemical reactions and major value and opportunities and propositions for people. So in the Connect model, largely the exchange, the clearing houses, the regulators essentially played the role of a system transformer, a system and a converter. We are able to convert the massive differences in China's market and the global practices into a way for them to talk. So languages can be translated, voltages can be converted, different shape of pipes, can be connected, so that investors on either side of that market are able to largely trade, largely according to their own habits, their own market, infrastructure and habits, and allow them, however, to connect with vastly different market structures on the other side of the market. That's really the model of Shanghai Hong Kong Connect. In the FIC space, obviously, there are important differences. There are a lot of similarities. China, very different. China is very big, massive liquidity on both sides, massive need for that liquidity to converge, and massive product needs. And all of that is similar in equity, commodities, and FIC. But in FIC, there are significant differences. And here is a largely an institutional market rather than a retail market. Over time, China's retail market will become very important for the FIC space, but initially, the institutional market is the most important market. And also here, cash trading and derivative trading are very different. In the FIC space, cash-bound trading, is important in the global scene, but it's not really that great, yet, particularly in Hong Kong and China, because cash trading, cash-bound are not necessarily traded, massively. However, FIC, fixed income and currency derivatives, futures product are obviously extraordinarily important because at the end of the day, it's all about risk management, of rates changes. So those differences present tremendous amount of different challenges for the exchange, for the banks, for the regulators, and for all of us institutionals and investors and intermediaries to figure out a way to accelerate this open. And because it's different from the Stock Connect, and it's similar in concept but different in practices. So here, what role Hong Kong can play? In addition to just this is not only a liquidity meeting liquidity. This is really about a number of issues. First, if Hong Kong as an offshore center, an offshore market can clearly provide very useful venue for China to experiment rate discovery in Hong Kong, and with some insulation at the border, so that development of that rate discovery mechanism allows China to accelerate the reform of its market and interest rate reform and exchange rate reform without necessarily to be completely exposed to significant volatilities that happens outside China's border. And Hong Kong can play the very important intermediary role of creating a rates market of RMB, both in credit and exchange, and then that allow China to take that rate back into the rate formation processes in China, but without necessarily unduly affected by potential surges and declines of international rates when China needs to sometimes make temporary adjustment. So that sort of offshore rate discovery experiment is very important and is very useful, and we strongly advocate with China's authorities that this is the right way for them to start, and Hong Kong is the right place for them to do that. We are also looking at the significant transformation and transfer or migration of wealth from the banking sector, from the deposits, into the investment scheme, into real product, in the diversification. So Hong Kong in the next decade will probably need to look at itself not only as what our historical role as a capital formation center for China, we really should become the wealth management center for China. That is, we are now, we used to represent international money to negotiate a way to move that capital into China. And now we need to find ways to negotiate the significant migration of wealth to either be in Hong Kong, through Hong Kong, or use Hong Kong as a way to access international product so that China's national wealth can be properly and globally deployed, and through a great, efficient distribution system that allows that wealth to be accessed and diversified into the global investment community and investment opportunities. And so the system, the third key role that we can play is that in the fixed income and currency market, it's all about regulatory interaction. It's all about clearing houses and market infrastructure players to provide the services and manage the risk and interact with global regulators. It's a huge theme for all financial institutions, particularly the banks here. So Hong Kong, being an international city, and we need to be, and we do not mind, being completely regulated, not only by our regulators, and when circumstances requires that we wanted to be, winning the regulatory, approvals from other jurisdictions. So we don't mind to be, regulated on certain aspect of our clearing houses by CFTC or EMIR, and that this sort of internationalization of our clearing system, of our market infrastructures, allow global financial institutions to deal with our market infrastructure here, to put margin and deposit and use our clearing system and infrastructure system, but somehow invested in the onshore system. I think it will still take a lot of time for China to gradually move into a scene where their regulators are able to work together with international regulators. So that particular international role of Hong Kong give us tremendous edge to accelerate the overall RMB internationalization and the onshore advancement for international money, and also the export of China's wealth for global deployment and global wealth management. So in conclusion, the opportunity lies ahead are huge, extraordinarily promising, but there are a lot of work that need to be done. FIC, unlike equity, is not a low-hanging fruit. It's not something you can immediately pick on what you have just labored. You need to wait. You need to really it takes the time to get the market infrastructure there, to get the regulatory infrastructure there, to get the regulatory sign-off there, and ultimately need to get the institutions, both onshore and offshore, to find a way for them to manage the risk, to find a way so everybody feel that there can be a win-win situation, because the onshore and offshore rate differences and the political and economic pressures of the regulators are fundamentally different, and how to make sure that ultimately we find all of ourselves working towards the same goal and aligning our broader interest and find the best way for us to go forward is really the collective challenges we will all be facing. Many of you are working very successfully in many of the current fields where it's already opened. I think what you're working on is only representing a very small fraction of what you could potentially be working on next year this time, the year after that. So I do see tremendous opportunity, but a lot of challenges and a lot of work and a lot of investment. Is going to take time for a lot of this to materialize. But when they do, the opportunities in the FIC space is ultimately going to dwarf anything else that we have seen in equity or even in commodities, because this fundamentally represents the foundation of money. So I want you to have a great conference. This is a great opportunity for us to have the best minds in this space into this room and be able to collectively exchange views. We have some expert and some great friends coming from other parts of the world here today, and hopefully you will all be able to learn something from each other, and together, hopefully we will be able to not only witnessing history in the making, but also be part of it in making it happen. Thank you very much.